Now, we're about ready to hear from President Joe Biden in regards to what to expect from the Silicon Valley bank collapse. And understand, those that invested in this bank will not be getting their money back. And you'll hear that straight from Joe Biden himself. But when it comes to the stock market, it's very important that you do your own diligence, that you learn the market from intelligent people that know the ins and outs of the market. And at the end of this video, I'm going to show you a great channel where you can go, and they don't recommend that you buy stocks, but they talk about these different stocks, and they lead you to good areas to do your own diligence. But they also help you understand how the market works and how you can actually make money in a bull market or a bear market. But here's President Joe Biden, and very important that you listen to this. And we're going to go back to, I think it was the 9th of February, where Jim Cramer was recommending Silicon Valley bank stock.
Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law.
Everybody that's watched my videos understand how important it is that I give you the timeline of everything that transpires. And we're going to zoom in on this and scroll down a little bit so you can see this was put up on February 8th, 2023. And this is Jim Cramer recommending SVB, that Silicon Valley Bank, is a stock that you might want to purchase and put in your portfolio. We're going to listen to what he says here in a minute. But understand, not everybody gets it right all the time. So I'm not hating on Jim Cramer, but there's a lot of people out there that might have taken his advice and bought into this failing bank. And if you ask me, my personal opinion, the bank failed because of wokeism. So you want to be very careful about investing in woke corporations, because history has shown, and not too distant history, that if you go woke, you go broke. So let's listen to what Jim Cramer said on February 8th, 2023, and then we're going to take you to a good place to learn about the stock market, or to just find some great people to hang out with. They're live now, and they run and stream 24/7. On the weekends, they do crypto, but it's just a really amazing channel. And if you watch this to the end, you'll be blessed in the future.
The ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Moffett-Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yes, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls 66%, like SVB Financial did last year, it takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it.
And this is the channel I was telling you about that I highly recommend to anybody that wants to learn how the stock market works. Right now, you see, we've got 202 people watching. That means there's 202 people with eyes on the market. And over here in the chat area is where you're free to talk and speak about what you want. And we're going to go and listen to them. They're live right now. And this channel is live 24/7, which is great. You can check in on it anytime you want. And they also give you free bull coins for just watching the channel, which is an amazing thing. And you got to subscribe to the channel, though. And we're going to listen to them where they're talking about the banks. So you're going to learn a little bit about the banks from the live discussion they're having. I had to back up to so I could record it. And this is today. This is from today. And they do not recommend for you to buy any stocks. They recommend that you do your own diligence, but they give you certain things to look at that you can look into, and you can see why they want you to look at it, whether it's a long play, which means you want the stock to go up, or it's a short play, expecting the stock to go down. But they never recommend buy this stock. You'll never get that here. And you got to buy this. There's so many people out there doing that, which is terrible because they're already invested in the stock. And the more people they can get to buy into the stock, then they make money. So, and that's the way the old stockbrokers used to do, because I remember that back in the 70s and the 80s, where you'd have to go to a stockbroker, and the stockbroker would recommend they get together their buddies, they'd buy into a stock, and then they'd tell all their clients, buy into this stock, and then it'd go up 10, 15%. They'd sell out of it and leave their clientele holding the bag, and then maybe later on recommend to them, okay, you might want to sell that with your 3% profit. So I'm going to zoom back into this, and we'll listen to a little discussion on how the banks are working and how they go about with stock investment and also shorting the market.
Got a question. I've got two questions here to ask from the audience. So audience members, you can ask the questions bottom right corner. So we have someone, a leading account on Twitter that shares news that all of you would know. They say the following. It's a pretty basic question, but maybe Jay, you can explain it to them. It's important to remember a lot in the audience are not as knowledgeable as many of you are. So I'm confused as to why some individuals are expressing concerns that the current situation may resemble the 2008 crash. While I'm aware the GFC crisis originated with the bankruptcy of Lehman, I believe that there will be significant indicators preceding a similar event, right? This is just with Silicon Valley Bank and some other banks, or I'll kind of add on some other smaller regional banks. Would anyone disagree with that statement? And also, Jay, as you answer this one, Jay, I want to add something to it before you respond. You've heard Wahid's narrative. He was here earlier. I think you jumped in right after, and you heard it yesterday as well. The sovereign debt around the world. Would love your thoughts on his position and whether you agree with this concern.
I agree. I've been bringing it up since the end of last year that every 1% increase in rates is a $400 billion hit to our deficit, given that half our debt is maturing over the next 3 years. I mean, in the U.S., it's very easy to quantify it. The Federal Reserve makes the data public. So one, I agree with him. There's a limit to how much the Fed can raise. I think above 6, a lot of things start to break. Not only commercial real estate, but corporations, just based on the fixed charge ratio of a lot of these bank lending deals that we've looked at. I just think it would be terrible. Now, going back to the Lehman situation, we were betting that something was going to happen in the residential real estate market in 2005. We were betting on it 3 years before it happened. The two Bear Stearns hedge funds defaulted in July of 2007. People had over a year to prepare after those Bear Stearns hedge funds blew up. And then in March of 2008, you had another big financial blip. So then you had another signal. You had multiple signals over several years where people knew the real estate market was overheated. They knew the rating agencies weren't doing the right thing. They knew there was no-doc lending. They knew there was toxic CDOs. And it just kept building and building and building and building on itself, where every single bank in the United States had some toxic assets. That's not the situation today. These banks do not have loads and loads of toxic assets. Now, they have some bad real estate loans that they have exposure to, but they don't have toxic assets where you don't know what the actual asset is worth. So I think this is a completely different scenario in the U.S. banking system overall. In a month, this is a recorded space. In a month, I don't think that we're going to have this issue. I think that the big banks are going to be fine. The small banks are going to have to raise capital. There are going to be some that go out of business. There are going to be some that are going to be taken over by bigger banks. But overall, we have 30 trillion of bank assets and 18 trillion of deposits. And if you assume all the stocks that saw 50% type moves today and last week just went to zero, it still would be less than $1 trillion. And as a percentage of the banking system in 08 versus now, it's a lot that's a lot less impactful than what happened in 2008. And that's assuming like a terrible scenario that all these banks just go to zero, which, I'm including names like Schwab, which I don't think are going to go to zero.
So just an update, NASDAQ is up 1.3%, S&P 500 up 0.8%. Michael, would love your thoughts on what Jay just said. And I see Wahid's back up on stage. We were just talking about your narrative, Wahid. Not sure if you heard Jay, but go ahead, Michael.
I think that's exactly right, and I think it's even. I would make the point even stronger. This is not 2008. Silicon Valley Bank is not Lehman Brothers. A major problem with the financial crisis was that banks held assets that were extremely difficult to value. We didn't know how much these assets were worth. We didn't know how much the houses were worth that underlay the mortgage-backed securities. We didn't know how much the mortgage-backed securities were worth. There's a sense in which that they were worth zero, but nobody wanted to sell them for zero. Nobody knew what the appropriate price to sell them was, et cetera, et cetera. And the contagion effects from the fact that this was in large part involving the housing sector, which meant that it was affecting the balance sheets of individual Americans, millions and millions and millions of individual Americans, allowed for there to be a mechanism by which problems in the financial sector spread into the real economy. There is just no parallel to that today in type or in scale. You can look at the balance sheet of Signature. You can look at the balance sheet of Silicon Valley Bank. You know what you're looking at. You know what the par value of the assets are that they hold. You know what the mark-to-market value of the assets are that they hold. The Fed has stopped, or I think the Fed will have successfully stopped there being spillovers into the real economy because the lending facility will allow for people who were expecting a paycheck today or expecting a paycheck tomorrow to receive that paycheck. And I think the risk of bank runs throughout the rest of the regional banking system have been substantially mitigated, if not entirely eliminated. So very, 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 very big differences between this and 08.
Absolutely. And I will say that it doesn't mean that
Check
all
the
those
volume
are over.
scanner.
And this is kind of round one. I do think that there's going to be
Okay, I'm going to stop this here and just let you know that check your volume scanner is an AI that Bulldog Trading has built into their YouTube channel that gives you alert to volume increase, whether it be selling or buying. And that means a whole lot of people all of a sudden started to buy into a certain stock, which jacks the price up or causes it to go down. And it's an amazing feature because you can check that stock symbol, see the volume, and a lot of times you can get in on the low end when it's pumping up. And using that feature, I have made up to 50% in a matter of 10 minutes on buying a certain stock and then getting out of it before it starts to come back down again. But it's an amazing feature. You also got people in the chat pointing out certain stocks and news that is breaking, and they're ahead of the curve. And it's just an amazing channel for you to learn about the stock market. Again, nobody's telling you anything to buy. They're recommending you look at things and do your own diligence. I've always said that's very important for you to never just blindly buy into something on somebody else's opinion. That's probably one of the worst things you could do. You have to research the stock a little bit. There's many tools online, and Bulldog Trading has a Reddit site, or not a Reddit site, but a Discord that gives you a bunch of tools to work with. It's just an amazing channel to learn the market. Link will be the first link in the description to Bulldog Trading. And like I've always said, seek the truth daily. The truth will find you seeking. And another thing to be aware of is that history, if you look back in history, it will give you a good understanding and comprehension of the present. But not only that, when you look at history and you look at the present, sometimes you can actually see what will transpire in the future. Thank you for watching. Please like, subscribe, share this video. And until my next video, God bless you.